Donald Trump's recent tariff strategy has escalated a previously simmering trade conflict into a full-scale war. On April 9th, he increased tariffs on Chinese imports to an astonishing 145%, marking the highest American trade barrier in over a century. Beijing retaliated swiftly, imposing 125% tariffs on U.S. goods, causing global markets to tremble. Executives at the Port of Los Angeles report a drastic two-thirds drop in import bookings since the announcement, predicting a double-digit decline in volumes by mid-summer 2025. Gold, often viewed as a safe haven, surged past $3,200 an ounce for the first time, recording its 23rd all-time high this year. Traders are again murmuring about a recession, and historical patterns support these concerns. Every sustained yield curve inversion since 1955 has been followed by a recession in the U.S., and the curve turned negative again in February. If you're waiting for an official recession announcement, you may already be too late. However, you need not succumb to the pressure. Here's a comprehensive, evidence-backed playbook, comprising 7 essential actions and a mindset adjustment to fortify you against recession threats during this tumultuous trade landscape. First, conduct a thorough audit of your financial situation. Recessions tend to penalize the uninformed, and warning signs are becoming evident. 30, 60, and 90-day late payments on credit cards have reached alarming record levels. Currently, the average revolving balance is around $7,200, a nearly 4% increase from last year. To stay ahead, you must track every dollar spent. Download a full year's worth of bank and credit card statements, categorizing each transaction as essential, growth-oriented, or discretionary. Tools such as Monarch Money and YNAB simplify this process, though a basic spreadsheet works just as well. Keep an eye out for unnoticed expenses, that subscription you meant to cancel, the fitness app used only twice, and hidden convenience fees that quietly empty your wallet. Tally these costs. The total might surprise you. Afterward, evaluate your debt situation. Balances accruing 20% interest or more are emergencies. Tackle them first before any further investments. One missed payment can devastate your credit score, increase future borrowing costs, and heighten stress during a recession. Lastly, create a cash flow projection for the next 6 months, including all fixed bills and average variable spending, then compare the total to your take-home income. If there's no room for flexibility, start cutting expenses while you still can. Second, establish a genuine emergency fund. Only about 30% of Americans increased their emergency savings last year, while over a quarter reported having less than the year before. The average job search now lasts nearly 24 weeks, nearly half a year, making the old 3-month savings rule outdated. If your profession is cyclical or heavily impacted by tariffs, aim for 6 to 12 months of essential living expenses. Store this money in a high-yield savings account or a treasury-backed money market fund to earn some interest while keeping it easy to access. Even saving $50 weekly can compound to $2,600 in a year. Automate these transfers during payday and allow time to do the rest. Treat this fund as sacred. Do not dip into it for vacations, gadgets, or emergencies that stem from poor planning. In a true economic downturn, this fund provides the priceless benefit of time, allowing for thoughtful decision-making without panic. Third, focus on investing in yourself. LinkedIn's latest Skills on the Rise list highlights AI literacy and large language model proficiency as the fastest-growing skills across all tracked regions, with conflict mitigation ranking closely behind. The number of job advertisements mentioning artificial intelligence has soared nearly 60% year over year. This means that in a downturn, your most valuable asset is not your 401k or your property. It's the versatile, future-ready skill set residing in your mind. Consider enrolling in a prompt engineering micro-credential, mastering data storytelling, or taking a short course on cross-cultural negotiation, essential in a world where supply chains shift rapidly. Dedicate at least 5% of your income to education. If funds are tight, utilize free MOOCs from MIT X Pro, Google Career Certificates, or Khan Academy's new AI-focused programs. Research consistently shows that lifelong learners earn more and enjoy longer job stability. Keep in mind that the goal is not merely to enhance your resume, it's about creating opportunities. When layoffs occur, multi-skilled individuals can transition into similar roles or freelance effectively. minimizing disruption to their lives. Fourth, enhance your network proactively. Conservative estimates indicate that over 70% of jobs are filled through referrals or personal connections. This isn't favoritism, it stems from trust. Companies seek to mitigate risks during downturns, and a warm introduction from a known contact significantly lowers hiring risks. Allocate 1 hour weekly for intentional outreach. Engage thoughtfully with industry posts, share helpful data insights, and connect 2 colleagues who may benefit from knowing each other. Always send thank you notes after meaningful discussions. Gratitude is both memorable and rare. Maintain a spreadsheet documenting your interactions, including details on who you spoke with, their interests, and your last contact. Building relationships fosters goodwill long before you need to reach out for assistance. Don't forget, casual acquaintances often yield the most significant career opportunities because they provide insights and chances outside your immediate network. Fifth, protect yourself from lifestyle inflation. Last quarter, the average credit card balance rose to $6,700, with auto loans and buy now, pay later debts hitting record heights. Before upgrading your vehicle, renovating your home, or booking that extravagant vacation, perform a recession stress test. If your income dips by 30%, will you still manage the payments? If the answer is no, postpone the purchase. Embrace the value per use principle. A $100 pair of shoes worn 100 times costs only $1 per wear, while a $700 gadget used merely twice actually costs $350 per use. Invest the savings instead in experiences or assets that genuinely boost happiness or future earning potential. The aim isn't to live in extreme frugality, it's to maintain flexibility. A leaner budget allows you to pivot when opportunities arise or when income declines, preventing you from making desperate choices at the worst possible moment. Sixth, diversify your sources of income. Approximately 1/3 of American workers now engage in freelance or gig work at least part-time, contributing well over $1 trillion to the economy. This number is set to reach 50% within 5 years. Relying solely on one paycheck poses a significant risk. Choose a side gig that builds on your current expertise. Conduct freelance data audits if you're an analyst, engage with AI fine-tuning if you code, or create niche ebooks if you're a subject matter expert. Aim to generate at least one additional income stream that covers 15 to 20% of your fixed expenses. In this way, a job loss or a slowdown due to tariffs becomes a minor inconvenience rather than a disaster. Start small. Consider online tutoring, selling specialized templates, or licensing your photography. As this income expands, reinvest part of it into tools or training to help scale your side ventures. With time, you'll build a reliable multi-support structure. If one leg falters, the rest will keep you stable. Seventh, approach investing with a protective mindset. Gold's rapid climb past $3,200 highlights how quickly fear can influence capital movement. But gold is just one of several hedges. Historically, dividend growth stocks experience smaller downturns and recover faster than the wider market, since their distributions impose discipline and attract income-focused investors when rates decline. Maintain a low-cost index fund base. Add in dividend growers, and complement this with treasury ladders or inflation-protected bonds for stability. Continue dollar-cost averaging through market fluctuations to purchase more shares when prices decrease. Avoid falling into the trap of meme stock FOMO. Discipline consistently outperforms drama each market cycle. If market volatility keeps you awake at night, your portfolio may be too risky. Scale it back until you regain clarity. Remember, defensive investing isn't about perfectly timing the bottom. It's about ensuring you remain in the game long enough to capitalize on eventual recovery. Now develop a written action plan for potential downturns. Determine ahead of time which expenses will be cut if your income drops by 20, 30, or 40%. Identify which investments you'll acquire if markets decline by 20 or 30%. Perhaps increasing your S&P 500 index allocation or adding to a gold ETF. Document the contact numbers of your landlord, lender, and insurer for renegotiations if necessary. Keep this plan visible, taped to your fridge or saved as a note on your phone. In challenging times, emotions can run high. Having a predetermined roadmap keeps rational thinking at the forefront and prevents paralysis during critical moments. Lastly, safeguard your mindset. Economic downturns increase the risk of anxiety and depression by nearly 40 to 50%. Job or income loss during the pandemic led to more than 10% increases in psychological distress scores even 2 years later. Engage in 10 minutes of mindfulness, regular exercise, and a daily news fast to lower cortisol levels and enhance decision-making. Surround yourself with solution-focused individuals. Negativity spreads more rapidly than any virus. Remember, recessions do end. Those who emerge the strongest are those who view adversity as a temporary challenge rather than a permanent judgment on their worth. Consider setbacks as opportunities for growth rather than failures, allowing you to cultivate resilience that transforms hurdles into stepping stones. If you're genuinely committed to becoming recession-proof, type "I'm recession-proof" in the comments and subscribe for additional data-driven strategies. The trade war may persist, and headlines might blare, but you now possess both the protective shield and the navigational map. Let's not merely endure the approaching storm, let's harness it to propel ourselves forward.